Yeah, hi everyone. Yeah, thank you all for joining us today. Yeah, Adam and I are really thrilled to host today's webinar with our special guest Barry Bruce. Although he doesn't like the word venerable that much, Barry, yeah, I couldn't find a better word to describe you. Still,
How
I
about
like.
just old?
No, I want to call you like a venerable tax strategist, not because of age, but because of your incredible wisdom and lifelong passion for tax. He's been providing income and estate tax advice for almost 4 decades, and he's been helping especially real estate investors and business owners build their generational wealth through proven tax saving strategies. I personally liken investing to the offense in a sport and tax saving to the defense. So it goes out without saying you gotta do both well to win the wealth building game. So today we are here to learn more about the defense side. So how to better protect our assets and businesses. So Barry is going to talk about why it's important to keep asset protection in mind as an investor, to like why an LLC might be inadequate in asset protection, and how specialized trust can offer real bulletproof solution to asset protection. Yeah, to me and Adam, yeah, it was mind blowing to know what a trust can do to not only minimize ambush attacks from taxes and losses, but also maximize your control over your personal and business asset. I don't want to go any further to avoid stealing Barry's thunder. After his presentation, we'll open up the floor for him to answer your questions. So please leave your question in the chat box whenever they come to mind. Okay, so without further ado, let me hand it over to Barry. Barry, please take it away.
Okay. Well, thank you guys, both of you. It's been a lot of fun getting to know the two of you. Your client, who is also my client, is a delightful guy, and very appreciative that he introduced us to one another. And let me just cover a couple of things up front. Somewhere along the line, somebody's going to wonder about them. We're going to spend most of the rest of this time talking about some legal concepts, some accounting concepts, and somewhere along the line, somebody's going to wonder, whether I'm an attorney, whether I'm an accountant, and the answer to both of those questions is that I'm not. I got hired. Tay said, I've been doing this for 40 years, and that's the truth. October of 1981, I was 23 years old, and I looked like I was about 16. And I had a degree in child psychology. I'll just point out that that's perfect preparation for working with adults, as things have turned out. But I took a fair amount of ambition, and I hope a brain that maybe worked pretty well to this group that had the most amazing training program I've seen in 40 years. Within the space of about 18 months, they had me at a place where I was functionally quarterbacking the activities of the accountants, the attorneys, the bankers, investment people, insurance people, et cetera, that surround successful privately held business owners. Most of my clients were, for the first 30 years, were family-run businesses, and businesses that maybe, a couple of buddies got together and started a contracting company, or a couple of guys that met in engineering school that developed a process for bending stainless steel tubes that are used on automobile assembly lines and oil rigs and things like that. So they came from all different backgrounds, but they ended up mostly having a really a common set of problems. And at the top of that list of their challenges was that they were surrounded by advisors who spoke at them, not with them. And what I mean by that is it's a number of times I would meet somebody for the first time, start asking them some questions, most of my clients, their businesses would, they paid tax on a couple $100,000 a year to a couple million a year. They were good, solid businesses, and people who were heavily invested in real estate, either through their business or as their business. And, I might say something like, what's the plan from here? Do you have kids in the business or anything like that? Yeah, we've got some kids, and you want them to take over one day? Yeah, we want them to take over one day. So, is there anything formal? Do you have any kind of agreement in place? Oh, you mean one of these things? And they'd reach into a desk drawer, pull out this stack of quarter-inch worth of paper and blow the dust off the top and hand it to me. And when I'd leaf through it, I'd get to the end and notice that it wasn't signed. And say, okay, so this is kind of what we're talking about, but it's not signed. Is this just a copy? Is there something that is signed someplace, or have you just not signed it yet? And the answer that I would typically get would be, well, of course I haven't signed it. I don't understand what that daggone thing says. Because it was written in legalese. And this might be a really smart guy. It might have been somebody that graduated at the top of his engineering class. And when it came to figuring out how to bend and twist a piece of steel that started off maybe 18 or 24 inches long and ultimately ended up a couple of feet long, several feet long, bent in all kinds of directions, and an oil rig in the Gulf of Mexico couldn't operate without that tube. So he was brilliant at what he did, but he didn't speak legalese. And since the financial statements that he got from his accountant or his bookkeeper, or maybe his CPA, were always delayed. I had a client one time refer to them as, oh, you mean footprints in the snow? And I said, oh, yeah, I get it. I understand. It's like you're getting information that's so late that it doesn't do you any good. And what I learned how to do was to speak English, translate the legalese into English, into common plain language, so that I could explain things to people who were really smart at what they did. They just weren't really smart at the law or at accounting or whatever. And then once they understood what it was that was in the documents, I could say, so is this pretty much what you want, or is what you want done different than this? And sometimes they'd say, yeah, this is pretty good. And then we go get it signed. And other times, most of the time, they would say, no, that's not what I want. Well, how would it be different for you? What do you want it to say in order to make it work the way that you want it to work? And we talk back and forth, sometimes literally drawing pictures, diagrams, to make sure that it was a plan that made sense for that person. And once we had the plan, then I would retranslate it into the legalese and go meet with his attorneys that, they're charging him $350 an hour or whatever they're charging. And they wouldn't talk to him as if it was necessary for him to understand. And he wouldn't make decisions, he being a generic he, representative of 25, 30 years worth of clients. They wouldn't make decisions until they understood what was going on, right? And so what I bring to the table at this point, I believe, is about 40 years of experience of working with the principal owners of very good privately held companies and people who are heavily invested in real estate, whether it's real estate for their own companies or whether the renting of real estate is a part of their business. The very first one of these specific trusts that I had anything to do with setting up was set up back in 1993. That fellow's still alive. He owns about 45, maybe 50 doors worth of rental residential property in his trust. He's been sued a couple of times. He prevailed in both of the lawsuits. The most recent one was back in 2000. That it was actually the state that he lives in, had come after him for something that they didn't like, and they tried 3 different times to sue him. And the last time they tried was in 2000, and he hasn't heard from them since. He's filed tax returns using his trust since about 2005 for those rental properties. And what I'm hoping to walk you through is not theory. This is practical applications of what a number of people that I have worked with over the years have turned to as a way of getting what we call bulletproof asset protection get them estate planning that is flexible enough to adapt, like today with whatever's going on with Congress, with the new administration. There's all kinds of conversations about, changing this and changing that. And most of what they're talking about changing intentionally does not apply to the way that we do estate planning using these specific trusts. And then, as both Tay and Adam said, there are also some pretty fascinating and interesting income tax planning opportunities. I refer to them as income tax mitigation. Mitigation meaning anybody who walks away from the presentation thinking that, I spent some time with Barry and he was telling me all about this thing that's going to wipe out my tax bill. That's not at all what I said. But we can significantly reduce tax liabilities, and there are some circumstances where we really can wipe out an important part of somebody's tax bill, and we're going to give you some examples of that and walk you through all of this. The only reason I've left this Dynasty Spendthrift Trust up here, this initial slide up there so long, is if you look in the really fine print where it says Be Still Irrevocable Trust, and then down at the bottom it says Barry at wildcatlaneadvisors.com, right? I don't just talk about these trusts. I have a trust that I operate my business out of, right? That is this Wildcat Lane Advisors reference you see here. And the assets that typically would be owned by somebody's family, in my family, they're owned by this Be Still Irrevocable Trust. So this isn't theory to me either. This is how I run my business and how my family lives our lives. Okay. So I'm not gonna read you these slides, and I'm probably not gonna cover them in order. I'm probably gonna cover them as I walk through the explanations in my own head. And the only thing that's important on that disclaimer page is just remember, this isn't legal advice. Every seminar you go to, every webinar you go to these days probably starts with the same thing. It's not legal advice. I don't know enough about your individual circumstances to give you qualified advice, even if I was an attorney. And the best way in the long run to get that kind of advice is to get yourself in front of somebody who's licensed to practice law in your state and who specializes in whatever the question area is that you have, of course. And you could have dozed off and wouldn't have missed anything in that couple of minutes there. So when we talk about classifications of trusts, for the most part, the place where that classifying gets done is in either the Internal Revenue Code, the federal tax code, or in the tax codes of the respective states. There are other places where the classification gets done, like in a courtroom, and those classifications are just as important in those locations as they are in front of a tax court or a tax form. Technically, the trust is what's referred to as a non-grantor trust. I promise you I'm going to do my best not to bore you to tears with legal references, and I'm going to try to get things translated into language that is normal enough for us to have an intelligent conversation about things. One way that trusts are classified is as either non-grantor or grantor trusts. And all that really matters about that is, I would imagine, honestly, in pretty much every audience, there's a good percentage of the people who already have a trust that's called a revocable trust. They set the trust up. They gifted some assets to it. They're the trustee. They're the beneficiary as long as they're alive. And those are good trusts. I'm not minimizing their value at all. They're very good for avoiding probate. They're particularly good in the event somebody becomes sick for a long period of time, or you get injured, and you have a successor that can take over the management of your assets immediately. You don't have to go to court and get appointed somebody's guardian, or to have the court ratify a power of attorney or anything like that. It's an immediate transfer. But But that revocable trust or self-trusteed living trust, some people refer to it, for income tax purposes, it's not recognized by the IRS. It doesn't exist in the terms of the IRS, according to the IRS. In almost every case, a revocable trust it uses the Social Security number of the person who created the trust as its tax number, right? Well, the person who creates a trust is called many things. Just depends on, where you're reading it, who you're listening to. In the IRS language, the person who creates a trust is called a grantor. They are granting this trust. It's derived from when the primary purpose of trusts was in Old England and had to do with deeding property from one person to another, and it was functionally, I am granting you this property, okay? A non-grantor trust means that the trust was created by somebody who's not you. And if that person is not only not you, but not your spouse, not one of your kids, not somebody that would be a beneficiary of the trust now or in the future, an independent somebody, in other words, then that trust is classified as a non-grantor trust. And a non-grantor trust is recognized by the Internal Revenue Code and by each of the states that has their own state income tax as a separate taxpayer. A non-grantor trust has to have its own EIN, its own tax identification number. And classification as a non-grantor trust is a very important part of how all of this works that we're going to lay out here tonight. Just like those of you that have LLCs or corporations or whatever, that there are some provisions within the Internal Revenue Code that only apply to LLCs or that only apply to family limited partnerships, et cetera. There are other provisions of the tax code that only apply to non-grantor trusts. And for all intent and purposes, a grantor trust is taxed just as if it was you, the individual, okay? Next thing, irrevocable. Irrevocable is a word that nobody likes, right? Especially business owners and investors. Nobody likes things that are irrevocable. So I need to make sure that you understand what is irrevocable, okay? So, and if you think about it, I've probably worked with the owners of about 175, maybe 200 businesses over the last bunch of years. For 30 years, most everything I did was between Richmond and New York. And the last 10 years has been pretty much across the country. But in that time, I've worked very closely, not just a couple of hours here and a couple of hours there, but I've worked very closely with about 175, maybe 200 business owners or companies. And I can promise you that none of them want anything that's irrevocable too. Right. So don't let this word scare you. Here is what is irrevocable. And this is the only thing that is irrevocable to qualify this kind of trust as irrevocable for IRS purposes. The person who sets the trust up, that grantor, the steps that they take to create the trust are irrevocable. Things that you, as the client, who probably would end up as a trustee, that's a term that I'm sure that most all of you are familiar with, probably all of you are familiar with. There's another player that we're going to introduce a little bit later called a trust protector, and that might be new to a number of you. But there are specific powers and authorities that are granted to both the trustee, most of the time that's my client, and the trust protector, all the time that's my client. We'll explain that later. To change, to modify, to add beneficiaries, name new trustees if an existing trustee becomes disabled or resigns. There are lots of powers and authorities to change this irrevocable trust. It's just that the grantor, the person who sets it up, is prohibited from changing anything. And that means they can't change any of the terms of the trust once it's signed. That means they can't affect control of income or principal of the trust once the trust is signed. They have no say in what happens with any of the assets. The grantor, in order to create the trust, usually puts up 50 or $100 to drop into the bank account to get the trust funded, it's called. And once they give up that $50, they can't even get that back. Right? It's the actions of the grantor that are irrevocable. And any of you who might do something with these trusts, none of you would be the grantor of your own trust. Hopefully I made that clear. Complex. Complex doesn't mean monstrously difficult to understand. In IRS jargon, complex means that these trusts are not required to pay all of their income each year to the beneficiaries. A trust that's required to pay all of its income to the beneficiaries is called a simple trust. And a trust that says you can pay some of the income to one beneficiary and some more to another beneficiary and none at all to a third beneficiary. In other words, if the trustee has discretion to sprinkle, that's what that's called, income amongst the beneficiaries, or if the trustee has the power and authority to not pay income to any of the beneficiaries for any reason or for a period of time and to accumulate it in the trust, then those kinds of powers, those kinds of discretions make the trust complex. As you'll see when we go through, there are really important benefits, both from an asset protection point of view and from an income tax planning point of view, that are available to through these trusts because they are classified as complex trusts. This is the way that I put it, and I try to explain it conceptually. My wife and I have a big family. It's big. I won't tell you how big; it'll make you groan. We have a whole bunch of grandkids at this point, and most of our kids are, just starting families. So who knows how many we're going to have in the long run. But one of our grandsons is 6, and he's profoundly autistic. Okay. At this point, it's likely that he will probably never live independently. That might not be so, and obviously I hope that that's not so. But realistically speaking, he'll probably never live independently. And in our family, my wife and I, forget these trusts, my wife and I, before we do anything to help any of the other kids in our family, before we do anything for ourselves, we make certain that Brantley, my grandson, and his mom, our daughter's a single mom. She's got a 6-year-old autistic kid and a 2-year-old, right? She's not able to work all that much because of our grandson's needs. And before any of the rest of us in this family take anything for ourselves, the first thing we do is make sure that his mom and our grandson have everything that they need, right? Which is probably what most of you would do in your families too. And part of the reason that it's important that these trusts are complex trusts is because they allow, the language of the trust allows my wife and I, as the trustees of one of those trusts, to basically use the trust to take care of whoever in our family needs the most help first. If there's something left over, then we can help take care of other people or do things for other people. And if there aren't any of those needs, then we're going to keep the money in the trust and do something with it down the road, right? That's what you get with a complex trust. Discretionary just refers to what I was describing earlier. We have a lot of discretion about how the income of the trust is used, tremendous amount of discretion about what happens with the assets that are owned. Not self-settled means, in the eyes of the IRS, that I didn't set the trust up. The grantor, the person who created my trust, is my brother. Okay? He has an acknowledged, affectionate relationship with me and with my kids and with our family. And it's not strange or unusual for him to have taken the step to set this trust up for us. Did I help him do it? Well, of course I did, right? Did I help him cross the T's and dot the I's? Of course I did. He's an architect. He's not a person that works with trusts. But literally, it was his Social Security number that we used to get the tax ID number for this trust. He is the one who signed the document to create the trust. He's also the one who put up the first $50 to open the bank account. And then one of the very first things that happened when he and I sat down to sign the instruments along with a notary is he signed a page that stipulates that from that point in time, from that exact moment, any right that he might ever have had to change anything about that trust, a term of the trust itself, to take his $50 back, any chance, any power or authority that he might ever have had to say, we're going to pay income to this person or not pay income to that person, all of those powers were forfeited and voided permanently. And at that point in time, none of our assets, my family's assets, had been transferred to the trust. It wasn't until after my brother had been, basically his role had been completed, that we started transferring assets to the trust. So there was never a moment in time when my family's assets, I'm not excluding my brother from my family, you understand what I'm saying? There's not a moment in time, not an instant, where the assets that belonged to my family when we started working with these trusts were ever under the control of anybody other than me or my wife. I do have some clients, just so you know, whose income tax situations with their businesses, especially those that have multiple businesses, sometimes their income tax situations get complex enough that there are some decisions that we have to have an independent person make officially. If we don't, then the IRS might disallow a deduction that's claimed, or they might say that a decision that got made was self-serving and not let him do what he was trying to do. And in those instances, we have the power and authority in the trust instrument to assign kind of like a power of attorney, a limited power of attorney. We have the ability to assign a trustee to handle that specific decision or handle that specific transaction, right? And apart from that, everything about this trust, everything that it owns, everything about the way that it operates is managed on a day-to-day basis by me and my wife as the trustees of that trust. We do have the authority, which we're going to talk about, we do have the authority to replace ourselves because we are that trust protector thing. And I'll get to that in just a couple of minutes. What I want you to understand at this point about a trust protector is think of it like this. If the CEO of a public company is the person who's empowered to run that business from day to day, the CEO doesn't have full authority. The CEO has to answer to a board of directors. And as long as the CEO is getting results that the board is pleased with, then the CEO keeps his job. Well, in this kind of trust design, the ultimate authority is that trust protector, right? I have a number of clients, as I said, who either for a period of time or for a specific task are not their own trustee. But other than a couple of people who are seriously ill at this point, I don't have anybody who is not their own trust protector, because the trust protector can replace a trustee. The trust protector can name a successor trustee. The trust protector can amend this quote unquote irrevocable trust in response to changes in tax codes or corrections that need to get made, changes in the number of beneficiaries or the needs of the beneficiaries, right? The ultimate authority in this kind of trust design is the trust protector, because if they are not then the trustee, they can at any time make themselves the trustee or make someone else a trustee. And none of this would work for asset protection purposes, for income tax planning purposes, for estate planning purposes. None of this would work if I had the power to be a trustee, the power to be a trust protector, and I was the grantor of the trust. What makes this whole thing work is that my brother is the one who set this trust up. And therefore, it's classified in the Internal Revenue Code as a non-grantor trust, and I can have some of these powers that we've been discussing, authorities, without jeopardizing the rest of the benefits that the trust is intended to provide. Okay. Spendthrift means, I guess most people probably have a reasonable understanding. If you think of a spendthrift as somebody that really just, they get a couple dollars in their hand and it's gone, right? In trust law, a spendthrift trust is a trust that limits the access that a beneficiary who's probably not going to handle the money responsibly would have to that money. It might even be limited to the extent that no money's ever distributed to that person. Money might be spent by the trustee on behalf of that person, or maybe a school bill gets paid directly to the school instead of giving the money to a parent who might do something other than what was intended with the money, and then the money's gone, the kid doesn't have the tuition paid and all of that. So spendthrift, in the context of these trusts, refers to specific provisions that are written into the trust. And the most important thing that they say, for reasons we'll explain a little bit later, is if the trustee of this trust is prohibited by the terms of the trust from distributing any money, whether it's income or principal, from this trust to anyone other than a beneficiary of the trust, then because the trust is a non-grantor trust and includes these spendthrift provisions, a creditor of the trustee or a creditor of that beneficiary does not have the right to what's called reach legally into the trust and take assets out of the trust, nor do they have the right to force distributions from the trust so that they can step in front of the beneficiary and grab that distribution. This is a really important part of how the asset protection benefits that are available to people who use these trusts are made possible. And dynasty trust is just a reference to the fact that these are intended to be generational trusts. They aren't like a trust that's created in somebody's will, and I have a will and I create the will that to have a trust that says, when my kids reach the age of 35, they can have half the money that was in the trust for them. And when they're 40, they can have the rest of it. And then the trust is terminated. It's done. It lasted long enough to distribute my assets. These trusts, on the other hand, are structured in 20-year terms. And they are intended to be renewed every 20 years. That renewal does not require that you file anything with whatever the state is that you live in at that time. You don't have to file anything with the IRS. You don't have to pay any money to the copyright holders for the trust. There's no cost. It's just a form. The trustee exercises an option to renew the trust, signs this form that's kept in the permanent records of the trust, has that form notarized, and that is the acknowledgement that's required to document if there's ever a question in the future about whether the trust was continued for an additional 20-year term or not. Just to give you some idea about how those terms can work, the state of Georgia recently, there's this old concept called the rule of perpetuities. Most of the states have repealed it entirely. And it gets pretty complicated to explain, so I'm not going to explain it in all of the legalese. It just basically limits the amount of time that a trust can stay in existence. And it used to be that period was 25 years after the death of the last person that was alive when I set the trust up. Okay. Well, 2 years ago, Georgia extended the maximum term for a trust in the state of Georgia from 90 years, which was a good bit more than 21 years, to 360 years. And there are a couple of states where the maximum term of the trust is 1,000 years. Okay. Probably I'm going to be gone by then. Okay. With these trusts, because they're renewed, you start a new term over anyway, and you would never get to the 21, to the 90, to the 360, or to the 1,000-year term, 1,000-year termination periods, as long as someone continues to renew the trusts. Okay, that's what it means. So that's kind of the overview. lot of time on one slide. We're going to go much more quickly through the rest of them. I just wanted to give you a feel for what the trust is all about. Okay. All right. This is one of the most important things to understand. There are trusts, probably if you do any real estate investing, if you own any rental property, if you're familiar with Section 1031 exchanges, you've probably heard the phrase Delaware Statutory Trust. Okay. And a lot of people have the idea that a Delaware Statutory Trust is a kind of investment. A Delaware Statutory Trust is actually a kind of trust. It was created kind of like a Delaware corporation, only it was created to be a trust and set up in accordance with a legislative act of the state of Delaware that defined all of the terms of this trust. For example, if you're going to have a Delaware statutory trust, you have to have at least one trustee who's a resident of Delaware. Doesn't have to be an attorney, just has to be somebody who lives in Delaware, right? One of the more common uses of Delaware statutory trusts is to purchase income-producing real estate, whether it's commercial or residential. And if that real estate if the legal structure within which that real estate is owned happens to be a Delaware statutory trust, then there's a revenue ruling from the Internal Revenue Service that authorizes an investment in that property to be an eligible replacement property to complete a Section 1031 exchange. Okay, so a lot of real estate investors understand what a Delaware statutory trust is, but in reality, it's not a real estate investment, it's a trust, and the form of the investment in the real estate takes place inside a Delaware statutory trust. If you look, if you ever find a really, really boring moment and you actually want to read any of the prospectus for a mutual fund that you've invested money in, if you read the really fine print, you'll probably find that most of the mutual funds themselves in the United States are organized as Delaware statutory trusts. It's a very common way for financial assets to be owned. All right. The alternative to a statutory trust, where you create this trust and you have to abide by the rules of a particular state, is what's called a common law trust. And a common law trust is rooted in the Old English common law history that was brought to the United States from England when the country was being settled. Okay. And under the terms of common law, this kind of trust agreement is technically a contract. This is super important to understand the asset protection benefits. Okay. Instead of this trust being used as kind of like an estate planning device only, technically, this trust is a contract between the grantor who sets it up, the person who created it, right, and the initial trustee and the initial trust protector. And this contract is really no different in form. It's different in substance, in the function of it, but it's not any different in form than a contract to buy a house or a contract to buy a car or a contract to go to work for someone or to not compete with them if you leave their employ, right? It's the same kind of structure where there is an agreement that is made between parties to the contract, terms that are laid out of the contract, and then consideration that cements the whole thing. Consideration is just value that's provided to evidence the sincerity of the people to be held accountable to the terms of that agreement. Okay. And this trust is a contract between the grantor who sets it up and the initial trustee and trust protector. Right. We'll come back to that a little bit later. We're going to go through a couple slides about the trust protector now, and I just want to make the initial point. This will help you make sense out of the role. The trustee is a fiduciary. If that term's new to you, basically a fiduciary is kind of like maybe a banker or maybe an attorney. It's somebody who is supposed to put the interests of their customer or their client legally ahead of their own. If I am a fiduciary who has responsibility for money that belongs to you, I'm not supposed to do with that money what I want to do with it for myself. I'm supposed to use that money for your benefit and not commingle any of it with mine, not use it for my purposes, not use the property that I'm holding for you to get a great deal on a piece of rental property for myself by selling it to myself, right? That's a violation of my fiduciary responsibilities because I'm not treating your part of that relationship as more important than mine, okay? A trust protector is not a fiduciary. A trust protector is, in its essence, there to represent the beneficiaries of the trust. Remember, these trusts are supposed to last for generations, okay? I have no idea who the trustee of my family's trust is going to be 100 years from now. I hope the trust is still there, but I have no idea. The person's probably not born yet, okay? And if that person ends up being a real jerk and my heirs are stuck with a real jerk as their trustee, I want some way to boot that jerk to the curb. And the trust protector is how we get things like that done. So the trust protector is there to legally make sure that the interests of the beneficiaries are being provided for by the trustee and to replace the trustee without any appeal on the part of the trustee if, in the trust protector's opinion, the trustee is violating that fiduciary responsibility. Hopefully that makes sense, okay? All right, so once the contract, I'm saying contract, once the trust agreement, which is functionally a contract, has been signed, then just like what you're used to, all the responsibility to manage the assets that are owned by the trust, all the authority to manage those assets is held by the trustee. And then authorities and powers and roles that you might not be familiar with are provided for the trust protector. For example, to remove and replace a trustee, to add and remove beneficiaries, to name successor trustees, to modify or amend the trust. One of the questions you might ask is, why would you want somebody to be able to remove a trustee? That sounds kind of mean, okay? Well, back to asset protection. One of the reasons you might want somebody to be removed as a beneficiary, especially if you have the right to add them back later, is that they're being sued at that moment. And if they're not a beneficiary at the time that they're being sued, or if they're not entitled to distributions from the trust after a judgment is rendered against them, then there's nothing for their creditor to get. So literally, there are times when maybe a beneficiary gets removed because they're a real jerk. But most of the time, the power to remove a beneficiary is part of protecting the asset base for the beneficiary, not a punitive thing, okay? Trust protectors' roles function like a board of directors. We already covered that. I told you we'd cover a lot of this stuff. Remove beneficiary, remove a trustee, talked about all of this stuff. Okay, so we're going to create the trust. I've already told you an independent third party creates the trust. They set it up. They put up $50 or $100 if their accountant or their attorney says, oh, that's not enough money. And the accountant says, I want it to be $1,000. Then we use $1,000. It doesn't matter. It's just a nominal sum of money to literally fund the initial bank account that belongs to the trust. And then this grantor person who sets it up is going away permanently, okay? The most important part of the grantor going away permanently is this slide, and that is the grantor's role is completed and terminated through the terms of the trust, through the terms of that contract. As soon as the trust itself is turned over to the trustee and the trust protector, the grantor's role is terminated permanently. And that means, as this slide says, that there will never be a moment where assets from my family would be under the control of my brother, even though he and I get along just fine, right? They're not his assets. And before I start putting any of our assets, my family's assets, into the trust, his role is gone and his authority is gone. Okay? Okay. Just covered that. Okay, this is an important point. Most of the time, people who have any experience with trusts are used to thinking about a trust that you give assets to, especially if you're familiar with those revocable trusts or the self-trusteed living trusts. Okay. Now, the way that those trusts get assets, if I set that trust up for myself, I'm going to take my house. I might take my car. I might take rental property I own. I might take bank accounts or mutual funds, or I might name the beneficiary of a life insurance policy to be that trust. Okay. But the trust is getting what it's getting through gifts from me. Okay. For these trusts to protect their status as non-grantor trusts, and most importantly, to make certain that these trusts are able to do things for the trustee, not just for the beneficiaries, but to legally do things for the trustees. We'll talk about those things a little bit. Assets that are conveyed to the trust by our client are sold to the trust, not given. Now, unrelated people who might want to give something to the trust are welcome to, but nobody who is a trustee, is a trust protector, might ever be a trustee or a trust protector or a beneficiary of the trust ever gives anything to the trust of this kind. They sell assets to the trust. I'm going to talk about that. Okay. When you sell an asset, when I sell a piece of rental property to my trust, in exchange for the legal title to that property, which is going to pass from me to me as the trustee of Be Still Irrevocable Trust dated such and such a date, or my successors in trust, that's the name on the deed now, okay? In return for transferring that property, I got what's called a demand note. A demand note might not be familiar to everybody, but it is a legal form of debt. It's a legal obligation of the party that is a debtor in a demand note. In this case, it would be my trust that bought something from me, right? The trust gives me a demand note instead of giving me cash. If you remember, I said most of the time we set the trusts up with maybe 50 or 100 bucks. And there's no piece of rental property that I have that I'm going to sell to the trust for 50 or 100 bucks. Being absurd, right? But even if the trust had $500,000 to buy that property, I still wouldn't take the $500,000 from the trust in exchange for the property. The whole idea is to get the assets into the trust and leave them there. That's where they're protected, right? If I swap a rental property that I used to own myself, sell the rental property to the trust and take $500,000 $1 bills out instead, well, I got an even easier target, a more attractive target for somebody that wants to sue me now. I used to have an illiquid piece of property that they might get toilet calls at 2 a.m. for. They didn't want that. They wanted cash. And now I just made it easy for them. Okay. This demand note works exactly as the name says. It's a demand note. It doesn't have regular monthly or quarterly payments. It has provisions that require the trust to make principal payments to me on my demand. Okay, so let's just make it easy and say I sold something to the trust for $300,000. Right? I got a demand note worth $300,000. That demand note is not assignable, not transferable. Right, which means that I am the only one to whom that note can ever be paid, including a bankruptcy court. Okay, not making that up. Because that note is non-transferable in a bankruptcy filing, that note is not an asset that the trustee can grab onto. Okay, if a bankruptcy trustee can't get to it, I guarantee you that nobody I bump into at a traffic light is going to be able to get to it, right? The demand note, let's give you an example. Let's say that my wife and I want to take our family on a cruise. All right, we're going to drop $20,000 on the cruise, okay? If I take $20,000 out of the trust and pay for that $20,000 cruise, or have the trust use its debit card to pay the expenses instead, then I'm subject to what's called self-dealing. Self-dealing means that the IRS is probably going to charge me income tax on that $20,000. It also means that the beneficiaries of the trust can literally sue me for that $20,000, for the return of that $20,000, because the trust itself is technically set up for the benefit of my heirs, what are called, in the law, they're called remaindermen. When I'm dead, the remainder of whatever was mine is supposed to go to them through this trust, right? And if I'm using those assets for myself, then I'm not doing what the trust agreement, what the contract said is supposed to be done. However, if the trust owes me money, that's a different story. So I sold something to the trust for $300,000. I had the trust spend $20,000 on a cruise, right? That $20,000 gets posted to the financial statements for the trust at the end of the year, just like financial statements for a business, balance sheet, profit and loss, statement of income, cash flow, the same kinds of financial statements that you would be expecting to see if you were a business owner, right? And at the end of the year, that $20,000 expense comes up, and the people that do the tax returns for the trust will say, okay, so the trust used to owe Barry $300,000. He spent $20,000, and it was a loan payment. There's interest that's got to be paid on that. What's called applicable federal rate, that just means the rate that the Internal Revenue Code says you have to charge at a minimum to have a valid note for demand notes, right now is literally 0.19%. That's less than 1/4%. Okay. And I'm not doing math by 0.19. Okay. So let's just say 1%. So the trust spent $20,000 of its money on the cruise that my wife and I took for our family, right? 1% of $20,000 is $200. So $200 will hit my personal income tax return for 2021 as interest income. The other $19,800 gets posted to the financial statements for the trust as a payment of principal, which is not taxable to me. It literally reduces the debt and increases the value of the assets in the trust. So I'm not doing anything to any of the beneficiaries, and I'm not self-dealing because I'm a legitimate creditor of the trust. The only basis for me being able to use the trust to have it do things for me is that the trust owes me money based on the way that assets got transferred to the trust. Hopefully that makes sense, because this is an important part of how these things work. Okay, what's it like to live with the trust? For the most part, if you're a business owner and you're used to signing your name, comma president or comma member, you're already used to the principal part of the day-to-day, and that is you don't sign your name Barry Bruce, you sign it Barry Bruce, comma trustee, as the trustee of the trust, or Barry Bruce, comma trust protector, right? The bottom line to the rest of that slide, and this one too, is you do what you do with a business. You keep receipts. You wouldn't, if you had $1 million of payroll in your business and you were getting audited, you wouldn't go to the audit without payroll reports, because if you sat in front of the auditor and the auditor said, okay, you got $1 million worth of payroll stuff here, can I see some evidence? And you go, well, I don't have any evidence. I didn't bring anything with me. I just take my word for it. You're going to lose that argument, right? But if you go in there armed with boxes of reports and all of that kind of stuff, then you're doing the things that logically you should do to be able to substantiate your right to claim those deductions, right? And it's the same with these trusts. If I take that $20,000 cruise, I promise you I'm going to document it so that the tax people who do the returns for the trust understand it, and so that if we ever do end up in an audit, by the way, that guy that I set the trust up in 1993 has never been audited with the trust. And not only that, but these trusts are examined for tax return purposes. They're examined by the Estates and Trust Division of the IRS, which is the smallest group within the IRS. Okay. There is a paid tax preparer in Texas. I've never met him face to face, but I've talked with him a number of times. I know that he exists. I know that he's real and all of that. He's been doing tax returns for these kinds of trusts for a little over 25 years and estimates that he's probably done about 8,000 returns in that period of time. Okay. He's never had one return audited. And that doesn't mean, I don't want you to take from what I'm saying or from when I say that I know of one audit that was initiated literally by a taxpayer's son, if you can imagine such a thing. His mom had one of these trusts. He was a young CPA. He, like Adam and Tay have suggested, had a little trouble wrapping their brain around how you could do these things in the beginning. And he was afraid that his mom had been hoodwinked or manipulated in some way. So he took her records to the IRS and asked the IRS to audit them. I've never heard of that. All right. And there was no change. I know of one other audit that's going on right now. And it started as an audit of 2017, 18, and 19. They're all the way through 17 and 18. There are no changes. And they're working on the 2019 returns at this point. I'm not saying that you'll never get audited. I'm not saying that just because 8,000 people before you have had their returns passed through an IRS computer and none of them got audited, that means that everything is done exactly the way the IRS would insist that it get done. Nobody has that kind of knowledge to be able to say that for a fact. But what I can say honestly is this. I know that most of what we're going to talk about when we get to the case studies is as black and white in the tax code as standard deductions are, right? And I also know that whether everything was done exactly the way a particular IRS examiner would have said it should have been done or not on those other 8,000 returns, every single one of them got through without being adjusted. So the taxpayers got the exact tax result that they had expected to get in the first place. And that's all the certainty that's as far as I want to take what I'm saying about audits and things like that. For some of my clients, they're comfortable with things that have been done before. If I can get in a parade with 8,000 other people, that's good enough for me. All right. I have other clients who that's not good enough for. They want much more certainty than that. Maybe they're a little more skittish about lots of things in life. Okay. And that's why for those clients, we get legal tax opinion letters that address whatever the tax issues are about their particular use of this trust. And when I say a tax opinion letter, it's important to understand that we're not talking about a memo that somebody who's a licensed attorney wrote and put up on the internet someplace for people to read. That's not a tax opinion letter. That's a lawyer's opinion, but it's not a tax opinion letter. A tax opinion letter is created for one attorney's client at a time. That person has to be a fee-paying client of that attorney. The document is privileged, meaning that I have never seen any of the tax opinion letters that were created for my clients. I connected them to the attorneys that wrote the opinion letters, but I'm not allowed to see those letters. If I see those letters, then the IRS has the right to say, well, you shared it with Barry, you're going to share it with us, right? And that defeats the purpose of those opinion letters. But a properly done tax opinion letter is a very good device to use for having penalties and interests waived if an IRS case goes against you. And if the case is really sophisticated, really complex, we very often go as far as to have the client pay for a rider that gets added to the attorney's errors and omissions policy that states that in the end, even additional tax that has to be paid can be paid as a claim against that attorney's E&O policy. Okay. So for clients that are super skittish about everything, we get tax opinions. If they're really, really skittish, all right, we get riders put on the attorney's errors and omissions coverage to make certain that our client's not even on the hook for any tax change in the tax, let alone interest and penalties. Okay. but I don't want to overstate anything and say there's no chance you're ever going to get audited. You're never going to pay taxes again. All of that stuff's ridiculous. And those things don't exist anywhere. And you all know that logically, right? Okay. Now we talked about expenses paid by the trust. We talked about the financial statements. Talked about the things that as the trustee you can do. I just want to mention quickly that because this trust is classified as a non-grantor trust, it is able to do anything in the tax code that you as an individual are allowed to do. For example, this trust can complete a 1031 exchange. If the trust owns rental property, the trust can use a 1031 exchange the same as you can, okay? If the trust is an angel investor and puts up $100,000 of capital to help somebody get a business started, as long as that business is organized in the way that it needs to be so that Section 1202 of the Internal Revenue Code applies to it, means it has to be a regular corporation and some other qualifying things, right? But if that startup company is properly organized and a trust of this kind is an investor in that company, then the trust can permanently exclude, like eliminate, 10 times its investment in that company from capital gains. If you put 100 grand into that startup company and the startup company is properly organized, you can permanently exclude $1 million of capital gain from capital gains taxes through Section 1202. Okay? Principal purpose of these trusts is not minimizing taxes. The principal purpose of these trusts is asset protection that can't be defeated, other than two exceptions. I'll tell you what they are right now. If you think about it politically, this will make sense. If I get divorced and I owe spousal support to my wife and I don't pay it, she can reach into that trust and make the trustee pay money to her. And if we have minor kids that I'm supposed to be paying child support on and I don't pay that, then along with not getting my driver's license renewed, whoever that money is supposed to go to for the child support can get money out of the trust too. And apart from that, literally, those are called exception creditors. And apart from that, other than the IRS and the individual states, the powers that are never going to give up their right to take your money away, right? The only human beings that can get at the principal or the income of that trust are a former spouse who's not getting spousal support and a guardian who's not getting child support. Okay? Okay. First rule of tax planning. When you do get to tax planning, the first rule of tax planning is don't lose your assets, right? That's why, to me, I say the principal purpose of these trusts is asset protection, first and foremost. You can do all the you can know 1031s inside and out. You could have explained Section 1202 to the rest of the people on the call. And if you lose your assets because a guest in a property that you are renting to somebody slips and falls and bumps their head, gets a judgment against you, whether it's justifiable or not in your soul, as long as the court says the award is justifiable and they get a judgment for $2 million, then it doesn't matter what kind of tax planning you did on that $2 million. And oh, by the way, if you live in about 20 of the states across the country, don't expect your drawing a complete blank. Your liability insurance, your personal liability insurance, to cover any punitive portions of that award, because in about 20 states across the country, it's not legal for punitive damages to be insured. The whole idea behind that is that if somebody's done something wrong, they shouldn't benefit by having the policyholders of the insurance company cover their losses, right? So about 20 states in the country, you can't legally insure punitive judgment awards, okay? All right. This is the most important thing about asset protection to understand. Asset protection is not about eliminating the chance that you can get sued. You can expand the roof on your patio and obscure somebody's view of the sunset in your neighborhood, and they can sue you for whatever it is that they think you've done to hurt them, right? Nobody can stop you from getting sued. Asset protection does not mean that I can sets you up so you never have to pay a dime in legal fees. You might have to defend a suit against you. You have a property that's not well maintained, that you're renting to other people, and somebody gets hurt there. I can promise you're going to have to defend that suit, right? With this trust or without that trust, right? Asset protection means that even if I lose the suit, even if my now creditor has a judgment against me, or what's called a charging order. Charging order is kind of like a judgment. It just says they can step in front of any distribution that's supposed to be paid to me from a company or a trust or anything else, right? Even if my creditor has a judgment and a charging order, if the contract to which those assets are subject stipulates that the trustee is prohibited from paying any money from the principal or income of that trust to any person who is not a beneficiary of that trust, then the laws of the 50 states and DC all include provisions that say for the courts in that state to force the trustee to pay money to somebody who's not a beneficiary of that trust would be the same as forcing the trustee to breach the contract that's at the heart of this agreement. And each of the states has their own provisions. In Florida, it's called the Florida State Statutes. In California, it's actually the California Probate Code. Just depends on what state you're in. But they all have these provisions that say that in the presence of a contract, the trustee is prohibited to pay money to somebody who's not a beneficiary. So I bump into somebody at a traffic light. They break their arm. They lose a couple of weeks worth of work. They come to me. We go through a court process. I was on the phone at the time and, I screwed up. All right. And they get a judgment against me for $2 million. All right. Guy lost 2 weeks of work and broke his arm. Okay. But, I have some money, so that means I shouldn't have it and he should have more of it and all that kind of stuff. So that's just kind of how things work in the courts, right? So figuratively, not literally, he shows up at my door with his judgment and says, by the way, pal, you owe me $2 million. Make it payable to me, okay? The trust agreement, the contract to which my assets are subject says I can't write him that check. And the courts back my agreement, not his judgment. Okay? So this would be my reaction. Look, the courts will not force me to distribute money out of the trust. Here, you can take the agreement. Take this to your attorney. Make sure when you see your attorney that he sees this trust, because the first thing he's going to tell you is that he'll work for you, but he's going to do it on an hourly rate basis. He's not going to do it for 30% or 40% of the award because there isn't going to be one. All right? The agreement itself says, and the courts will back up, that that you can't force me to distribute money out of this trust to pay you. If you're willing to be reasonable, look, to me, you broke your arm. I'm sorry. I really am sorry that you broke your arm, right? It's a shame. You got some medical costs for that. You lost a couple of weeks' work. You make $1,000 a week. You got $2,500, $3,000 worth of lost wages and benefits and all that. Listen, if you'll take 20 grand to settle this mess, I'll get you the 20 grand and we'll be done. If you're going to insist on fleecing me for $2 million, then you can keep coming back and knocking on my door until you get tired of it. That client that I set the trust up for in 1993 that got ultimately sued by the state of Maryland, right? That's basically his response to the suit of Maryland. They came back 3 times. The last time was in 2000, and they haven't been back since. And since that time, he's built a portfolio of 45 or 50 rental doors worth of rental properties. Maybe it's 10 or 12 properties altogether. But that's how he makes his living. Okay? Being protected asset-wise means that in the red print, even if you lose the lawsuit and your new creditor has a judgment and a charging order, you are still in charge of when, if, and for how much that lawsuit gets settled. You have cards in the game instead of the creditor having all of the cards and the court behind him or her. Okay? That's asset protection. Okay, now we're going to switch gears a little bit. I told you earlier about the trust being a dynasty trust. There's no annual report that gets filed with states because it's not, these trusts are not creations of the state like a Florida LLC or a New Jersey corporation, right? California, you have a corporation or an LLC in California, the minimum annual fee is $800. And in the end, your fee is equal to 8% of your entity's income. So it's a minimum of $800, and it could be a whole lot more than that, just for the right to have their entity. These trusts are not created in accordance with the laws of any particular state. So there are no annual fees to pay to any of the states, no annual forms to get filed, etc. Okay, I'm just moving along here quickly to get some of these case studies. All right. So we covered a lot of this stuff. I just want to give you some objective information to back up some of what I've said. All right. If you do get sued, and you're depending on the fact that your property or your business or your assets that you're worried about are owned by an LLC or by a corporation, then the first fact that you need to know is that in about half the cases that end up in state court or federal court that involve someone who is trying to sue the owner of property for personal assets because of something that happened in their business, or for business assets because of something that happened in the owner's personal life, right? In roughly 5 out of 10 cases that go to court, the business owner loses. All it takes, and there's a Wake Forest Law Review study from 2010. There's a Hastings Business Law Journal from 2016. These are just samples. DuPage County of Illinois Bar Association. Illinois courts pierce corporate veil in 42 to 55% of cases. If your asset protection is based upon owning your assets in an LLC or a corporation, then basically you're looking at a coin flip to figure out whether you're going to come through that lawsuit with the same degree of control that we can create through these trusts. Okay. One of the biggest ways that plaintiffs' attorneys break down that wall that's supposed to separate business assets from the assets of the owner is a concept called alter ego. And what alter ego boils down to is a legal concept that says that really, if you own a small business, if it's you and your spouse, or it's you and 2 good friends from college, right? If it's you and your brother and sister, if it's 15 friends of yours, that really when it's time to decide what to do with the assets of that business, it's really you looking at you in the mirror. And in effect, it's kind of like you're wearing one pair of pants. It's got a pocket on the left side called you individually, and it's got a pocket on the right side called your business. But the person in the middle of it all is you. And if you have that ability to exert that kind of control over the business, then there's a very good chance that the plaintiff's lawyer, who wants to be your creditor's lawyer, is going to be able to break down that wall. Okay. And that's to say nothing about the kinds of things that everybody knows you can't do. You can't commingle the assets. You can't show up with a debit card that belongs to your business. You forgot your wallet, the card stuffed in the glove box of your truck. All right. And you pull that out to buy gas, on your way to a Little League game. If that stuff gets uncovered in a discovery process, the plaintiff's lawyer is going to be successful in tearing down the wall between your assets and your business assets. Those are the things everybody knows not to do. What people don't understand for the most part is this concept of alter ego. And it's so significant that see where it says in the middle of the page under the Wake Forest Law Review from 2010, piercing the corporate veil is limited to close corporations. What that means is in that entire Wake Forest Law Review study, they didn't find one instance of the corporate veil ever being pierced in a public company or for a company that's not classified as a close corporation. Close corporation in most states means it's got 35 or fewer owners. All right. most of my clients, and probably most of the people on the call, don't own their rental properties with 34 other people, right? Or 34 other owners. So you're one of those close corporations. And then you say, but Barry, I'm not a corporation. I'm an LLC. Okay? Okay. So let's look at LLCs. Sorry. A member of a limited liability company shall be subject to liability under the common law governing alter ego liability and shall also be personally liable. Remember, we're talking about a member of a limited liability company, right? We're not talking about corporations. Under a judgment of court for any debt, obligation, or liability of the limited liability company, whether that liability arises in contract, tort, or otherwise, under the same or similar circumstances, here's the red print, to the same exact extent as a shareholder of a corporation may be personally liable for any debt, obligation, or liability of the corporation. And that's from the California Corporations Code. In other words, that is the state law in California. And you say, yeah, but that's California and everything's all screwed up in California. It's always all screwed up in California. So let's go to Nevada instead, where asset protection is supposed to be its best in the country. We conclude that Nevada revised statute, that's what NRS means, is not intended to shield members or managers from liability for personal negligence. We further conclude that the corporate alter ego doctrine applies to LLCs. This is Nevada, not California, okay? My whole point to all of this stuff is that probably you, like me, for a long time, I was told the same kinds of things you were probably told. You start in business, you get yourself an LLC. When I started in business, you get yourself an S corporation. LLCs didn't exist yet. We did have color TV, but and color sunrises. You know, by the time I was out of high school, we were getting color sunrises. So, when it comes to asset protection, if you're depending on corporations and LLCs or family limited partnerships are better than LLCs and corporations, but they're still penetratable. Okay. If you're depending on those things, then the statistics are, the objective data is that about half the time you're going to win and half the time you're going to lose. I don't like those odds. Right? Not for a life's worth of work in your business or to accumulate properties that other people didn't take the risks for. You took the risks for. And you got a 50-50 chance of losing it if a problem crops up. Okay? This will show you how old I am, that I actually knew who Sun Tzu was. I didn't go to school with him, but I knew who he is. I know who he is. Right? And two of my favorite quotes of his, and who knows if they're really his. I wasn't there to record them. Right? But if you're outnumbered in an open field, retreat and draw the enemy into a narrow canyon where your archers can occupy the rim. And an expert in battle moves the enemy to where conditions favor the expert. The whole point behind those quotes is this. If you go into a court of law in a lawsuit armed with, but I've got a corporation, but I've got an LLC, and you're allowing that part of the code of that state to control how the game is going to get played, you're at a disadvantage. You got a 50-50 chance of winning. But if you can change the rules of the game, if you can move the battle from an area where you're probably going to lose to where you've got a really good chance to succeed, then that's smart. And that's what I mean by getting out of the tort room, tort law, and forcing the person that wants to take money from you to play according to the rule of contracts, where the contract says, pal, if you're not a beneficiary of this trust, I am legally precluded from giving you any of the money. You want to talk and be reasonable? We'll get this thing settled. If you don't, you're on your own. Okay. Spendthrift trust, there's spendthrift provisions we already talked about. That's what's at the heart of the asset protection. Let's see, and I just repeated this slide because after we went through all that stuff, the detailed court cases and state law and all that stuff, I just repeated the slide that you saw a good while ago at this point that says asset protection is not about keeping you from getting sued. It's about keeping you in control of how the suit gets resolved. Okay, the estate planning concepts that relate to this trust, the estate planning possibilities that relate to this trust. Like pretty much any trust, it's very good at helping to avoid probate, all right? Just like the revocable living trusts and those things. It's very good at providing a means to immediately transfer management responsibility to my wife or to one of our adult kids. If she and I are hurt in a traffic accident, we don't have to wait for the court to act on a power of attorney or anything else. If the physician who attends me certifies that I am disabled to the point where I can't manage my own affairs, then one of our kids takes over as the trustee immediately, and we don't skip a beat. ILIT means Irrevocable Life Insurance Trust, right? One of the things that's going on in the House Ways and Means Committee right now is a tremendous push to basically eliminate the provisions that allow someone, a business owner or a property owner who owns significant illiquid assets and is worried about the estate tax consequences. Like, I own a business that's worth a fair amount of money. Before it can pass to my kids, they've got to pay estate tax on the value of that business. And they've got 9 months to raise the money. What if it's a couple $1 million? How are they going to raise a couple $1 million without me here to run the business? What bank is going to loan them a couple $1 million for them to go run a business to pay the money to the IRS? They're not even going to get to put it in inventory. They're just going to turn it over in a tax bill. Well, a solution that's been used for decades in those circumstances is to get life insurance on the life of the business owner or the property owner, have it paid to a specialized kind of trust called an irrevocable life insurance trust. The person who sets the trust up makes gifts to that trust to pay the premiums, okay? Well, with our trust, remember, we don't make gifts. We sell assets, okay? So in our case, we have a companion irrevocable life insurance trust that's synced completely with this Dynasty Spendthrift Trust. And the premiums for the life insurance trust are not paid by gifts. They're paid by loans that are made instead of gifts that are made by either the person who's setting the trust up or somebody else. Or in a lot of cases these days, they're literally made by financing that comes from a bank, a loan that's given to the trust to make those premium payments. It's not a gift. It is a literal loan signed for, etc. And at a conference that I was at this past Wednesday, Thursday, and Friday with Notre Dame School of Law, they were talking about all kinds of things that people are worried about getting changed. And there were two things that the presenters kept coming back to as concepts that they were certain were going to survive. One was the use of loans and loans for payment of premiums for these irrevocable life insurance trusts so that the death that causes an estate tax problem provides the cash to pay the tax, right? And the other thing we'll talk about in just a minute, the other thing I'll say about the estate planning capabilities of these trusts are, if you're familiar at all with what's called generation skipping tax. Generation skipping tax says that if I have assets, and instead of giving them to one of my kids, I give them to one of my grandkids while my kid is alive, then the IRS taxes that gift at the highest estate tax level because I skipped over my kid, which in their minds means I skipped over their chance to collect some taxes when my kid dies and went right to my grandkids, and they don't like that. With these trusts, generation skipping isn't an issue because the things that cause assets to be included in somebody's estate are written out of this trust anyway. The beneficiaries in these trusts are there to have the trustee use the assets of the trust to do things for the beneficiaries, not to distribute money out to the beneficiaries and then have them do it themselves. The money stays in the trust because that's how we protect it from the claims of creditors. And because of other consequences of the money staying in the trust and the language of the trust, we don't have to deal with generation skipping issues. And that's a big deal for larger estates. I'm sure that everybody's heard these days that, back in 2017, the amount of property that you could pass tax-free to your heirs jumped from about $5 million to $11.5 million and a husband and wife together between them can pass about $23 million tax-free to their kids. And for most households in the United States, that takes care of the estate tax for everybody. That law's as it was originally written, it was supposed to scale back to $5 million at the end of 2025. And one of the proposals from the House Ways and Means Committee that's being supported by the president is to make the effective date of that change December 31st of this year. Okay, so there are an awful lot of households that forgot about estate taxes for a good while because they could. They didn't have 20 million. Maybe they had 8, 7, 10, 15, but they didn't have 20. And the likelihood is that they're going to have to reprioritize estate planning. Okay, remember there were two things I said were surviving in all those conversations at that symposium. One of the most important things, and for any of you that are business owners or are kids of business owners, man, if you can wrap your brain around this one, I'm not sure you'll sleep well tonight in a good way. Okay, if you've got 2 or 3 years before you want to sell your company, I need 2 years. I literally need 2 years in a day. All right. But if you have 2 years, maybe 3 or 4 before you know that you want to sell your business either to your kids or to outsiders or whatever, we create one of these trusts and we sell the business to the trust today. When you sell it to the trust, you sell it using a 25 or a 30-year interest-only installment note. And the provisions of Section 453 of the Internal Revenue Code could not be more clear, could not be more black and white, as long as you cross the T's and dot the I's that apply to these installment loans, and as long as the buyer of what you're selling holds the asset for 2 years and a day, then your installment treatment on your sale is locked in, which means you sell a company for $2 million that you started on a shoestring, right? You owe hundreds of thousands of dollars of capital gains on that sale. Instead, you sell it to the trust using a 25 or 30-year installment, interest-only installment note, right? As long as the buyer holds that property for 2 years and a day, like the trust, as long as the trust holds that property for 2 years and a day, you won't pay any of that capital gains tax for 25 or 30 years. I'm 64. I'm not sure what kind of tax I'm going to be aware of in 25 or 30 years from now, but I'm not really all that worried about a tax that comes along in 25 or 30 years, especially if I can put a couple $100,000 that would have disappeared in taxes to work for 25 or 30 years before I have to pay up on the original gain. I don't know what the rate's going to be. Maybe the rate will be 100% 30 years from now on capital gains, but it'll still be capital gains, and my gain will still be what it was back in 2021 when I have to settle up. All right. So if they want me to pay the entire amount of the value of the property, then I'll pay it, because between now and 25 or 30 years from now, I'm going to compound that money that I didn't pay in tax to an awful lot more than the original value of that company. What was your business worth 25 or 30 years ago, for example? Okay. I'm going to go to the next slide quick. It's a similar concept, but I'm going to use investment property instead of a business. The same basic concept up front. You sell instead of doing a 1031 yourself, right? You sell the business. If you've got a property that's got a bunch of rolled up gain in it, maybe you've got a couple of properties that have rolled up gain in them from 1031s that you've done in the past. Or maybe you took one property and you sold it, and you sold it, and you sold it, and you kept doing 1031s for the last 30 years. And you've got a property today that's worth a lot of money that's got next to no basis left in it at all, okay? Instead of doing a 1031, you can sell that property to the trust, use a 25 or 30-year installment, interest-only installment note, right? You're going to defer all of the tax on all of that gain, not just the gain on the last property you bought, but the gain on all the properties you rolled up into that series of property over the decades, okay? You're going to defer all of that tax for the balance of 25 or 30 years, as long as the trust holds onto the property for 2 years and a day. Then the trust can sell the property to anybody. Okay? It can sell it to one of your kids. It could sell it to a perfect stranger. Okay? When the trust sells the property, the worst that happens is the trust has whatever the market value was today when you sold the property to the trust as its basis. Okay? Which means that all of that rolled up deferred gain disappeared from the equation. If you wrap your brain around that one and understand what that means to you financially, I'm sure that you'll think about it for a good long time. Okay? That's the worst case, because the best case is, remember I said that the trust itself could complete a 1031 exchange? Okay? Maybe what you decide to do is have the trust buy a piece of rental property for the benefit of your heirs. All right? Make one of your kids that's young and hungry and doesn't mind getting phone calls at 2 a.m. for toilet repairs because they're getting phone calls at 2 a.m. from their buddies to go out, right? Make one of them the trustee for that particular asset within your trust, right? And let the trust rent that property out, rent the replacement property out. You defer all of the gain on your sale to the trust originally, and all of the gain as long as the trust itself owns rental property. There are even some provisions in what's called the Principal and Income Act of each of the states that, under certain circumstances, can create the opportunity for the trust itself, without doing a 1031, just provisions of the Principal and Income Act that apply to the trust because it's a non-grantor trust. There are provisions that could, under certain circumstances, make it so that the trust could defer the tax on its sale of the property until the trust terminates. And remember, we said if we do this right, these trusts are supposed to be generational. That's a long time to defer a tax bill. Okay? All right, I think that's pretty much it. I tried to give you an overview of the trusts. I tried to give you a couple of specific examples that might apply in your world about how the asset protection benefits could work, how the estate planning opportunities can work, about how you can use the trust either on its own or in conjunction with other tools to do some pretty creative and effective income tax planning. All right. And I appreciate your patience. I much prefer being able to do it when I'm talking with somebody and we stop and start and tackle their questions. We just can't do that in a group format. If you do have any questions at this point that I can answer for you, then obviously I'd be happy to do that. And I know you've been patient for a really long time. I appreciate it. And if you have any questions, I'll tackle them.
Okay, so who has a question? We're ready to go. Thank you so much, by the way, Barry. That was wow. There's a lot of information to take in. Thank you.
You're welcome, of course. They don't have any questions because they're all sleeping.
No, I guess you covered a lot of ground already.
Right. It is an enormous amount to wrap your brain around. So let me just let me just say this. If you have any reason to think that these trusts might be useful for you, then just reach back out to Adam, reach out to Tay, and they have all my contact info. I don't charge a dime to help somebody figure out whether these trusts really have applicability to their situation or not. What we usually do is schedule about an hour and a half, maybe 2-hour conversation to go through the facts and circumstances of your situation. Anything that you're willing to share with me about your assets, about your family makeup, about issues that you are concerned about, etc. We go through those, and then we see whether there are solutions inherent in these trusts. If I think they can help you, I will tell you. If I think they can't, I will tell you that, and probably have some other ideas for you because I've been doing this for 40 years.
We do actually have some. We do have a question from Jay Chen.
How does one guy go that long without taking a breath?
So the question is, actually, this is something that I know we discussed prior. Under this trust that the property is held under, how do you refinance into another type of loan?
Okay. So there's a couple of ways to do it. Remember that one of the things I said is the trust has the same kinds of financial statements created for it that a business would. All right. I'm not saying that you're going to be able to borrow money from every bank in the country using one of these trusts, because they're specialized trusts. Okay. But what I am saying is, if you start by working with commercial lenders, then you're probably on a fairly even footing with businesses that are with corporations and LLCs that are trying to borrow money. Okay. So one way that we handle it is to work with lenders that we know are set up specifically, whether they're private lenders or they're institutional lenders, banks, et cetera, that are set up to work with high net worth people who are likely to be using these kinds of trusts. If you think about a company like Wilmington Trust in Delaware, it's a huge financial organization, and there are lots of Wilmington Trust clients who are using borrowed money to flip houses or to expand a business or to factor invoices, all of those things. So is it more challenging at times? Yes, it is more challenging at times. One of the things we do almost immediately when somebody gets their trust set up is to apply for a Dun & Bradstreet number for the trust. And then we'll start with Home Depot. Go get a Home Depot card for your trust. Just start building a credit history along with the financial statements, right, that are created for the trust. And then think of it this way too. If you know that financing is an important part of how you're building what you're trying to build, then maybe we don't put all of your assets into the trust. Maybe we hold a few things out, specifically for the purpose of using them as collateral, right? And as you purchase assets using financing, then you immediately sell those assets to the trust for one of those demand notes, so that in time, the demand note can do more and more things for you yourself as the trustee. And then, it's the same as a business. It's the same as a person. We build a credit history, right? So part of the answer is we have lenders who are used to lending to these kinds of trusts, and we help our clients get in touch with those people if their lender, if it's just over their head, and we have other ways of skinning that same cat.
That's actually a good thing, Barry. Off this webinar, I definitely want to set up a call with you and Jay, because I know I was trying to help with this scenario on board. It's a way which it's another, I guess, conversation.
Sure, that's fine. Yeah, you don't have to go into it now. Just
yeah,
right.
But thank you so much.
I have I spent about an hour and a half with a new trust client this morning. She's a young gal. She's a realtor in Miami. Has her MBA and a JD. She has I don't think she's more than her early 30s. She's got a couple $1 million of net liquid net worth. And one of the things she does with the money in her trust is bridge loans. So I am helping her arrange a $525,000 functionally hard money loan for two guys who flipped a bunch of houses. They probably flipped about 40 altogether in Tennessee. And somehow they met each other somewhere along the line. And we're finalizing the $525,000 of loans that she is making. They're T's crossed and I's dotted, secured. Title companies involved in all of it. Everything is being done right. But that's what I'm saying. In times, it's private sources of money that we can provide access to, and at times it's institutional sources.
Now you got me thinking about something, right?
Sorry.
So what's very interesting, because I've gotten involved in bridge lending about 10 years ago, let's say, right?
Okay.
And Tay and I, we've been working on a new business plan because we saw the evolution in this hard money or bridge lending. It's become Wall Street driven, meaning there's a lot of money.
A lot of hedge fund money in it.
What's happening is there's liquidity in this market, right?
Yeah.
So as an investor in bridge loans, right, there's actually a way you could transfer the risk.
Yeah.
Meaning you could actually take this loan.
She could take that loan and capitalize it.
Sell it, the loan.
Monetize it. Yeah.
What you do is you take this loan, you sell to a loan buyer.
Yeah.
So the way lenders make money is you make points.
Yep.
Let's say you originate at 10%, your floor is at 6.5%, you sell the loan, you make that spread.
Yep.
Keep the points. You keep on recycling that capital. The question is, can you do this under that trust?
Yes.
So
not only can you do it under this trust, but it's entirely possible given the facts and circumstances. There's a slide in here about a business trust that's a companion to this. There's a second trust called a business trust. I operate my business using that business trust. The only beneficiary of that trust is the trust that we've been talking about all night. Okay. Mm-hmm. This quote unquote personal trust. Okay. Mm-hmm. So everything that this gal in Miami is doing with her bridge loans is literally being done through just a personal trust. She doesn't even need a business trust because the financing produces passive income. The nature of what she's investing in creates passive income, which is what the personal trust is designed to be able to tax mitigate. Yeah.
That's another conversation we could have.
That's another conversation.
It's very interesting. I'm very passionate about bridge lending, but it's amazing. What's some other questions we have? I don't want to miss anything.
Yeah, you have some question from Susan Loring.
Okay, the question is, I put rental in name of my living trust, but does not save me estate tax. I have a special needs.
Doesn't save her income tax either.
Yeah, I have a special needs third-party trust, irrevocable, but right now, no assets in that trust. I get to deduct cost on my personal 1030. If I put a special needs trust, could not get to itemize in my tax return, is there another solution to estate tax problem?
Okay, so she's blending a number of things in that question. Okay, the bottom line is that a very common use of these trusts is to take care of special needs situations without all of the rigidity that's inherent in the way special needs trusts usually have to get set up. Okay, it's the special needs person literally ends up. I hate to use the word just in here because I don't want to say just a person, right? But the special needs person ends up as just another beneficiary in this trust that's set up to take care of beneficiaries. And since the trustee has the discretion about how the income of the trust gets used, if the trustee decides, hey, this year, more of the money that we've got available is going to go to take care of the special needs child, and everybody else is going to, you're competent, go work. That's my family with my autistic grandson. We don't have a special needs trust. We have a much better trust that, in effect, keeps my wife's and my ability to take care of our family in the way that we would try to take care of them without the trust in the first place. But we get to wrap it all inside this trust that protects the assets from the claims of creditors, that takes care of our estate planning related stuff. And oh, by the way, if we sell a piece of property and we don't wait till the last minute to get it done, right? We sell it on an installment basis. We have the trust do the 1031 exchange, et cetera, et cetera, et cetera. And my special needs grandson will have access to an awful lot more capital during his lifetime because of this trust to take care of his needs. If that makes sense.
Does that answer your question, Susan?
She's got a lot of details in there in her question that we would have to talk through some of those details to understand exactly what she's driving at with parts of the question. I'm trying to address the bigger picture at this point about how special needs get taken care of within these trusts. There are all kinds of tax mitigation opportunities that are more significant than the opportunities that are present in a literal special needs trust.
Sure. And it may be a conversation off this
off the call, right.
Jay Chen. So his question is basically, does it make sense to set up a Nevada LLC as beneficiaries under the trust for additional layer of protection?
Okay, so you don't need it for the additional layer of protection, all right? Even a Nevada LLC. And I'll just tell you that more often than Nevada, we use Wyoming when we use them. And the reason that we use Wyoming LLCs instead of Nevada is because Wyoming is the only state in the country that offers the same asset protection to single member LLCs that they do to multi-member LLCs. And if a client comes to us with a stock portfolio that's got an awful lot of gain built into it when they get to us, then we're probably going to end up using a single member LLC as a part of how we get those assets into the trust without triggering a 1099 that would require them to recognize all the gain right then. Okay. But for the most part, we don't use LLCs for asset protection purposes, even in conjunction with the trust. Where we do use LLCs, let's say that you and Tay, as an example, find a piece of commercial property that you want to buy together. You have a trust and Tay has a trust, okay? Instead of having your trust and his trust on the deed for the property and then trying to figure out how do we get a bank account opened, for the rent to get deposited into, et cetera, we would probably end up setting things up with what's called a manager managed LLC that's owned 90% by your trust and Tay's trust and 5% by the two of you as individuals. The two of you as the individuals are the only management. You have the only management authority for the entire thing. It's kind of like voting and non-voting stock in a corporation, right? And we can't get 100% tax mitigation in that scenario, but we can get mitigation for all of the parts of that LLC that are owned by the trust. With me? So functionally in that scenario I just gave you, you tell me you got the property under contract, you had it under contract as and/or assigns, and I say, okay, give me a couple of days, I'll get a Wyoming LLC set up for you. Or if you live in California or you live in New Jersey, where it's expensive, it's just as expensive to have a bad LLC. And like in California, they charge a minimum of $800. If you have a Wyoming LLC and you live in California, the only way they'll let you use the Wyoming LLC in California is if you pay them the same minimum $800 to register your foreign LLC. So sometimes that complicates the picture, but most of the time we'll use a Wyoming LLC. You and Tay share some of that ownership yourselves individually. You share most of that ownership through your trusts. You get a bank account opened in the name of the LLC. You close in the name of the LLC. And administratively, it's just no different than if you'd set it up as an LLC only in the first place, because the only quote unquote voting interests in that LLC is the little bit that you have and the little bit that Tay has. That's an example of where we use LLCs for the purpose of making things administratively easier to get done at times. We don't ever use an LLC for asset protection because the asset protection of an LLC is inferior to the asset protection from the trust. Make sense?
That's perfectly clear. I get that. Thank you. Okay. Susan mentioned that the rental property will be going into third-party special needs trust when I pass.
Okay, when she passes. So she has no plans to transfer it now, then, in other words. And maybe one of the things that might make some sense is to use one of these trusts and literally make the transfer now with her as the trustee, right? And that property could be protected for a lot longer than just one generation, or the proceeds from the sale of that property could be protected for a lot longer than one generation, which is what functionally you would get with a special needs trust. And again, if you're not familiar with special needs trusts, there are a lot of hoops that you have to jump through, and those hoops are set by the individual states. Sometimes they're even affected by regulations in the counties where somebody lives. All right, but they're a very sophisticated and complicated thing. And in my experience, we sign our name, comma, trustee at the end of what we do for our special needs grandson, and then we just go about doing it without all the hoops that we have to jump through, that we would otherwise have to jump through. While we're talking about special needs, I'll just say this, and I don't mean it to be, I hope it doesn't offend anybody, but just another thought. You're talking about hoops that you jump through and special purposes and all that. Sometimes I laugh and call this trust the perfect prenuptial agreement. Okay. And I call it the perfect prenuptial agreement because it doesn't look at all like a prenuptial agreement. It doesn't even act like a prenuptial agreement until it's time for a postnuptial, right? Because remember, the trust protector can add and remove beneficiaries from the trust at any time. So we can be real sweet and everything can be wonderful and all of that all along. And if something happens and our relationship changes, well, it was rosy for a long time, and I didn't start off the relationship talking about prenuptials.
That's actually very interesting.
You don't want to say that right now. You don't want to say that. I've seen your wife in the background on things, and I know you're married. You don't want to say that it's interesting. You want to say that that's of interest to other people, is what you want to say.
Well, yeah, of course. I just was like, wow. I'm speechless. Basically, the point is this trust is multi-functional of ways to protect yourself, taxes, protect your assets through lawsuits, transfer of wealth,
right.
A breakup, if you will.
It is a tool though in the long run. It's not a dessert topping. It's not tickets to a World Series game. It's not the end all and the be all of things. This is a tool. And there are certain circumstances where the tool just doesn't work. There are some circumstances where it works a whole lot better than others. For the most part, I say the best opportunity for somebody to use this trust efficiently is if they own a business, a successful business, or they have accumulated a fair-sized real estate portfolio, right? Or they want to, either one of those things, to build it right from the beginning, Because trust me, if you can have all of your capital gains in your lifetime accumulate inside this trust, instead of transferring assets into the trust that have capital gains in them, man, that would be so sweet.
Okay, so let's say you sold the property, right? This is hypothetical. I just know this scenario. I know someone that sold something. They just they're gonna have about a $400,000 tax liability. The question, it just happened recently. The transaction closed about a week ago.
Yep.
Right, check cleared. Okay. Question is, can they open up the trust now and move? It's too late.
It's too late.
You have to do it before.
The asset literally has to be owned by the trust at closing.
At closing. So you have to set the trust.
Yes.
At closing and then do it.
And to be honest,
yeah.
This is important to understand. Okay. Remember that spectrum we were talking about earlier, where there's some people that You tell me I can get in line behind 8,000 other people and I'm okay with whatever the audit risks are. If nobody else has been audited, I'm good with that. You know, some people approach taxes like that, and other people, they just can't handle that. They'd be awake all night. You know, for them, we get the tax opinion letters and things like that, right? If you come to me and say, hey, I got a property under contract, hasn't been sold yet, but it's under contract. We're supposed to go to closing in 3 weeks. Okay. I heard about this trust. I want to defer my capital gains. I don't want to pay any capital gains. Okay. If you understand that to transfer the property to the trust today and resell it in 3 weeks probably presents at least a little opportunity, maybe, a little more than a little opportunity for you to get audited. By the time you look at the way the respective tax forms get filed, what's showing up in the IRS computers and all that, right? If you're willing to take that risk because you know that a good number of those 8,000 people that didn't get audited did exactly that, then we'll help you do it. I can tell you that you would not be able to get a tax opinion letter to stand behind that, right? The truth is that most tax returns don't get audited. We all know that, right? It's just regular old tax returns. Most of them don't get audited, right? But if you've owned a property for 10 years, right? Especially in high appreciation states, right? Think of this. You own a property in California for 15 years. You paid $300,000 for it 15 years ago. You just sold it for $1.3 million, right? But 3 weeks before you sold it for $300,000 to a trust so you wouldn't have any capital gain. You with me? And then 3 weeks later, the trust sells it for $1.3 million and it's got $1 million of profit inside the trust, and you're expecting to be able to do great things for yourself with that from now on, right? So in the 15 years that you owned the property, it didn't gain any value at all. And suddenly in 3 weeks, it went from being worth $300,000 to $1.3 million. That's a little fishy picture. Okay. I have some clients who have chosen to take that risk. They choose to go to the guy in Texas to have him do their tax returns because of his tax record. But I don't have any tax attorneys who are qualified to issue tax opinion letters who would issue a tax opinion letter that says that situation is more likely than not to work out the way the taxpayer wants it to. Because it's so last minute, right? And because the numbers are so skewed. No gain in 15 years, $1 million of gain in 3 weeks, right? So that's why the best uses for these trusts are to think ahead in your life a little bit, right? If you own a business, and you have kids and one or two of them are working in the business with you, you know whether or not they want to be in the business at some point in time. You know whether you think they can handle it and you want them to be. So a couple of years before you're getting really serious about maybe them taking over, start doing this kind of planning, right? A year and a half or two before you want to sell your 120,000 square foot warehouse, right? You're not expecting to sell that thing in 2 weeks anyway, right? So give us 2 years and a day, and we can send you to sleep with a really big smile on your face and do it all with tax opinion letters behind it. If you want them, tax opinion letter costs you $5,000, okay, to get that kind of tax opinion letter. But if it's going to save you $400,000 in capital gains tax and let you sleep at night, I'd say that's a pretty good use of $5,000, right? I'm just trying to make this realistic. And the reason that I'm trying to do this for whoever's left on the call is because you can get online and find people who hawk this kind of trust, peddle it, right, in the worst pejorative senses of the word, who don't understand a thing about how they really work or what lays behind them. And they're telling you things like, yeah, if you're an escrow now, tell me, I'll get you set up. And man, I'm telling you, no tax risks, no nothing. Just give me your money for your trust, right? And that's just crazy. If a client of mine understands what they're doing and says they're willing to take that risk, mean, and it's the world's full of people like that. You know, I have a very good friend of mine that's in the bar games business. You know, most of what gets paid into his company is dollar bills that get dropped in games. And it would be a fool who thought that every one of those dollar bills finds its way onto a tax form. Okay? People take understandable tax risks every day. And he works his butt off to not take stupid tax risks every day, right? So you have to use your brain, and you have to understand that it's not a free lunch and that it's not a gimmick or a game. If you're going to use this tool, be serious about what you're doing, and don't screw it up for yourself by being ridiculous. If that makes sense.
That makes a lot of sense. Thank you so much. So the key thing is, you said how long do they have to?
So I'm saying, so I can get a tax opinion letter if the trust owns the property for a year.
Okay, a year, 1 year.
I can, in most circumstances, I can get a tax opinion letter for the client if the sale to the trust and the sale by the trust occur in 2 different tax years, which is really easy to do this time of year. A little harder to do in January and February, right? It's very easy to arrange a closing in November and then arrange a second closing in February. It's 2 different years worth of tax forms hitting the computer system, right? To be able to do it with your eyes closed and not, and know that what you're doing is, again, as I said earlier, as black and white as taking a standard deduction, 2 years and a day for the tax purposes, right? But if what you're saying is the only thing I care about relative to this trust is the fact that maybe I can defer a couple $100,000 of capital gains taxes for 30 years, right? Then you're really missing the boat, because the benefits start with near perfect asset protection, right? And capabilities like we were talking about with Susan to make it easier to take care of people that matter than other options you have to take care of them, right? And oh, by the way, there are some really cool tax things you can do too. When you put one of those, like my business trust, okay? This little overview thing that we ran through with the slides, okay? I have about 20 hours of time in putting that together, okay? If I went to an attorney in the Baltimore area who has my experience with these things and had asked the attorney to put this overview together, I'd have probably paid $350 an hour for somebody to do that work. 20 hours of time, there's $7,000 for this document, okay? I created it. I created it myself. I sold it to my personal trust for the $7,000 in a way that I can substantiate with, the notes that I wrote down about how I came up with the trust, right? If you buy something for $7,000 in this day and age that you can lease, right? Interest rates being where they are at this point in time, you're probably looking at a payment of about $125 a month, somewhere in that range, right? So my business trust pays $125 a month to my personal trust for the right to use this piece of intellectual property in the conduct of my business, right? So during the course of the year, I'm writing off $150 a month as a lease payment from my business trust to my personal trust. That's a really simple example, right? Make it a rental property, where you're not talking about $150 a month, as long as you have, I have a client that owns an electrical contracting business, okay, in Massachusetts. He runs most of his business vehicle-wise out of 3 Mercedes-Benz Sprinter vans, okay? Well, once we set up his business trust and the personal trust, he sold the vans to the personal trust, right? We got Kelley Blue Book documentation to back up the value that he sold the vans to the trust for. I had him go to a Ryder and a Penske, 2 different Ryder and Penske truck leasing facilities in his area and say, look, This is the vehicles. This is the year. This is how they're outfitted. I'm interested in leasing. If you can find one for me, what would it cost me? And they wrote up proposals for him. So we used those third-party documents as the way we justify the lease payment that he's charging his company. We didn't just say, "Oh, let's make it $5,000 a month, and we'll get $60,000 of deductions for the business trust this year." You're being silly to do stuff like that. But there are a ton of people on the internet that are hawking these kinds of trusts that'll tell you can do stuff like that, and they're setting you up to get hurt. But they don't care because they're getting paid in year one. You with me?
I am 100% agreeable with you. There's a lot of you got to be very careful what you read on the internet, social media, Google searching.
Yep.
I know we were introduced to you, Barry, as a reference from another investor that used your services, and so a lot of times good reference. But thank you so much. Actually,
you're welcome. Of course, I appreciate the opportunity. I really do. I hope you guys got something out of it. I hope your guests got something out of it, and I really do appreciate it very much.
Yeah, we've been on here for over 2 hours.
Sorry.
No, it's great knowledge.
No, we really
I
love
just
this.
feel, I just feel for you because I know you have a long night.
Whatever.
And I thank you so much. Please, everybody, if you have any questions, you can reach out to Tay and I. We'll give you Barry's information. Please reach out. There's a lot of, I'm sure you may have questions, and we just want to thank everybody again. And, it's time to
say good night.
Say good night. I can't believe it's already 9:00 Eastern Standard Time. It's all right. Thank you, everybody, for joining.
Right. Thank you so much, guys.
Take care.
Thank you, Barry, and thank you, everyone. Yep.
All right. Bye-bye.